I've been very clear. I think that there's no reason to raise rates until you see the whites of inflation's eyes. And I look at the data out there, and I don't see inflation as close to the horizon. I think we've got to be focused on making sure that we're doing everything we can to grow this economy. I talked before about public investment. There's also a lot we can do to spur private investment, and I think government does need to recognize that confidence is the cheapest form of stimulus.
The central banks have to be very, very cautious. And in fact, one of the big risks to our view is a central bank policy mistake where they do hike too quickly, and as a result, either the economy slows down very sharply. Now, the biggest risk to our view of going back to target is the fact that the economy could fall back into some sort of a recession. Now, falling into recession from here, where you've only got inflation around 1%, core inflation, makes it much harder for monetary policy with the absence of fiscal policy to really boost inflation.
For the US, people will be looking for any sort of sign of disagreements within the sort of FOMC, and whether that matches or tallies with Yellen's subsequent comments. But as you say, it's kind of stale. It's a few weeks old. You've had a lot of data since then. The Bank of England is kind of the important one to watch because they're going to give you the fresh reading on fresh data. It's going to be the latest stuff. So I will be looking to them for estimates of what they see the impact of emerging market slowdown being on the UK. That will be the main thing to look for.
You've had the sense that Mark Carney has been more focused on the internal dynamics within the UK and has been focusing much more on that, and perhaps has had a little bit more of a hawkish tone actually than the Fed in some senses, if you read the runes of the language. Whether he can still do that within this broader context, certainly the market now isn't really looking for a rise for many, many months out now in the UK. But there'll be a difference, I think, between the action and the rhetoric.
No central bank really wants to preempt the Federal Reserve, I don't think, at the moment. Everyone's waiting to see what particular bullet is fired out of Yellen's gun. And the opacity of what's going on in central bank communications at the moment is only worsened. And I think the hawks on the European side of things will sit there and say, we don't have to pre-commit to anything around extension of QE beyond September 2016. But I still think that there's a possibility that certainly the impact at the shorter end of an interest rate cut would be a lot more beneficial for the European economy moving forward than simply more cash being thrown at it.